Have you ever wondered how much due diligence is enough? I have, and it is possible that you might be spending a little bit too much time on due diligence. The operative word here is might. This video might be a little controversial, but I hope that by the end of it, I will have at least given you a little bit of food for thought. Before we get into it, I need to clarify that this video is not giving you a free pass to skip or fudge your way through your DD process. If you watch my channel, you know how I feel about YOLOing your money recklessly. Remember, we can't be all vibes and no facts. Not when there's money on the line. Fuck! We need to find a balance between being overly cautious and playing Russian roulette with our financial future. Let's start with an interesting question. How much time do you spend doing due diligence on the stocks in your 401k? If you're like me, the answer to that question is 0. You don't. If you even know what the top 5 holdings in each of your funds is, you're probably in the 95th percentile of 401k investors.
Congratulations! Congratulations!
If you're like most people, you just rebalance your 401k whenever you remember that it exists, or when you get a new job every couple of years. While you're logged into your 401k account, you marvel at the 6% year-to-date returns, and switch back to your Robinhood account, where depending on your investment style, you're either up 80% year-to-date, or currently facing a margin call.
Oh my God!
I'm never gonna financially recover from this.
It's fortunate for us that Section 401k of the Internal Revenue Code incentivizes degenerate gamblers and their employers to create a pool of money that is at least in theory somewhat out of reach for impulsive YOLO trades. 401k returns aren't usually that impressive, but they are good enough to keep us on track for retirement. Probably. After all, anyone who's taken Finance 101 learns on day 1 the formula for becoming a millionaire. Very simply, it's the future value of your current account balance factoring in your expected rate of return. Here's the basic formula. You can complicate this as much as you like, or you can just Google a 401k value calculator and plug in a few variables. And voila, no scary math required. Here we see that a young degenerate earning $60,000 will be sitting on a cool mill by the time they're about 55, assuming a beginning portfolio value of $5,000, earning a 5% return, with regular contributions and an employer match. That's the power of compounding your returns over time. Sadly, due to entropy, time is the thing that's most precious to us. There are some people trying to work on a solution for the time problem, but I don't think it's wise to put our faith in those efforts. The time constraint we all face forces us to take excessive risks as we desperately search for a way to 100x our returns by the end of the current fiscal quarter, or if you're really down bad, by the end of the current fiscal day. Anyway, the reason I bring up the 401k is this. We can get away without doing any due diligence on the financial assets we're buying in our 401k because of how broadly diversified they are. If your 401k is spread out among 6 or 7 mutual funds, chances are you're broadly diversified across geographies, industries, and asset classes such as equities, bonds, commodities, etc. You can definitely mimic this broad diversification in your personal trading account by putting 30% of your money into an S&P index like QQQ and splitting the rest of your capital among international ETFs, bonds, material indices, and so on. But you probably don't do that. I sure as hell don't. That's not how most people invest, although QQQ is one of the most popular indexes out there. If you have a large account, chances are good that you own DIA or QQQ or VTI, while also owning a bunch of individual stocks. If you're like me, these are your fund stocks. Personally, I generally buy things in tranches of 100, so I can sell covered calls. I sometimes use strategies with fancy names like Jade this or Iron that, but most of what I do is sell calls and sell puts. Pretty beginner-friendly stuff, because I've found over time that advanced strategies often lead to advanced losses. As retail traders with day jobs, we don't have teams of analysts and break rooms stocked with organic, ethically sourced, single-origin cocaine who can spend months researching our holdings on an ongoing basis, only to advise us that we've screwed up royally and therefore need to eat a $400 million loss, only to have the stock recover like 6 months later, proving that none of us actually know what we're doing. If Pershing, with its big brain analysts, can get it so wrong, I can't just sit here and tell you that I have any idea what I'm doing. Sure, I can talk about technical analysis and net present value formulas, working capital and industry headwinds. But at the end of the day, I'm getting that information from outdated quarterly financials as well as other fallible analysts. Like most degenerates, we do our due diligence during the day while pretending to work. Or maybe over the weekend, during the 4 to 5 hour window in which we're not hungover. If you've been doing this for a while, you probably have a few stocks you've done a good amount of due diligence on over the years, and in which you feel comfortable taking and exiting positions after a quick refresher, which is to say that you're probably not going to be repeating your DD from scratch every time you re-enter that stock. You might check in on how their earnings and revenue growth are doing, as well as checking a few technical indicators to try to give yourself a good entry point, maybe scour the news for any new developments that might materially impact the company. But you're not going to bust out a 12-tab Excel workbook every time you want to re-enter the stock. What I find funny is that the reality of how many retail traders do their due diligence is not something they'd proudly say out loud. Like, no one would ever admit to half-assing their DD, which many people do, obviously. Present company included. The point I'm trying to make can easily be lost in semantics, so let me clarify that I'm not encouraging you to half-ass your DD process, but rather to recognize the limits of the DD that you can do as a retail trader. You can spend 1 month to get yourself 98% of the way to a potential buy decision on a stock whose price just dipped for no discernible reason. But if you waste another month to gain that additional 2% confidence to get yourself 100% of the way to a buy decision, chances are you missed out on a favorable entry point for that stock, because other investors may have noticed that dip and bought it, thus driving up the stock price and robbing you of precious gains. Again, I know this makes me sound like a bit of a contrarian, but investing in the stock market is a bit like the other parts of your life. Think of it, when it comes to subjects like science or politics, we tend to find a few people, experts, whom we consider trustworthy.
I don't like them putting chemicals in the water that turn the friggin' frogs gay. Do you understand that? Serious crap.
So we put a lot of weight on their insights. For example, most people don't understand how the legislative process works on a day-to-day mechanical level, but they're still capable of developing a somewhat coherent idea of policy positions they like and the potential downstream impacts of those policies. On second thought, maybe I'm giving people too much credit. The point is, we're all busy people and we can't know everything. So we focus our limited attention on things that provide us with the greatest value. We don't fact check every single data point Tommy Lee feeds us through CNBC, for example. He's obviously a very smart person, or they wouldn't let him speak on television. After all, we all know that they don't just let anyone speak on TV. Am I right? Anyway, you probably don't fact check every single thing that I tell you either. Or at least I hope you don't. The truth is, most people aren't overly concerned about technical minutiae in their daily financial lives. Ask yourself, how many people know what Yahoo Finance's methodology is for determining a stock's fair value? Probably not many. And why would they bother trying to figure it out when it's faster and easier to just compare it to another analyst's fair value estimate? Once you have that, you can put more weight on whichever figure helps validate your own confirmation bias. If you think the world is ending, you can do what I do and apply a bit of conservatism by arbitrarily shaving off 10 to 15% of that analyst's fair value. Again, not to sound like a contrarian, but dragging out your DD too long opens up a risk of you missing out on a well-timed entry point for a particular stock. Because by the time you're done looking at last quarter's outdated financial figures and doing all the boy math you need to convince yourself to buy the stock, it might have already appreciated 10 or 20%, especially in this ridiculous market. And if the world does end tomorrow, causing the stonks market to tank, it won't make a difference whether you did 10 hours or 20 hours of due diligence. So given that we need to be ready to make moves sooner rather than later, the question becomes, how much DD is enough? Before we continue, I'd like to tell you about my firm, Verity Accounting. Verity Accounting offers a full suite of services, including tax, audit, and attestation support, as well as bookkeeping and general advisory. So if you need help in any of these areas, feel free to reach out and we'll get you taken care of or hook you up with someone who can. Whether you're dealing with a complicated tax return, the IRS, or need audit procedures done, my firm, Verity Accounting, can help. So click on the link in the description or call the number on the screen right now for a free consultation. Now let's get back to the video. When we talk about doing DD, it can entail doing technical analysis and fundamental analysis. Technical analysis is the art of reading tea leaves. It's basically astrology for finance bros. When you do technical analysis, you're looking for chart patterns based on historical data that give you a clue as to whether the stock is likely to fall or rise in the future. Common technical indicators are the MACD crossover, RSI, resistance levels, and Bollinger Bands. Let's go over just a couple of these since we're on the topic. The moving average, convergence, divergence, or MACD is a technical indicator that helps you identify potential entry points for buying or selling a security. It works by overlaying a 26-day exponential moving average onto a 12-day exponential moving average, or EMA. Since the 12-day EMA uses fewer data points, it's more volatile. So when it crosses the 26-day EMA, that suggests a change in the trend of the stock price. For example, if the 12-day EMA crosses the 26-day EMA in an upward fashion from below, that suggests the stock might be about to rise, and vice versa. Resistance levels are another technical indicator I like to look at. This might be one of my favorites because it's so simple that it can be used by someone who is functionally illiterate. You basically just look at the stock chart for a given time period and draw lines at what appear to be the upper and lower limits of that stock price. A lot of people take this a little too far, so try to use a bit of common sense. Anyway, if you buy a stock near the bottom resistance level, odds are you got a decent deal, assuming no material changes to the business or its industry. So buying near a bottom is better than not doing that. Conversely, you might consider selling a stock if it's near an upper resistance level. Basically, resistance levels help you buy low and sell high. Stop me if I'm going too fast. Let's briefly touch on fundamental analysis. Fundamental analysis is anything that involves financial statements, balance sheets, ratios, really any piece of information that feeds into or gives you insight into the overall valuation of a company. While technical analysis tells you where the stock is headed, fundamental analysis tells you what the stock's price should be. Your job as an amateur gambler in the financial markets is to A, determine using fundamental analysis whether or not a stock is a good value at its current price, and B, determine whether it is likely to sink or rise in the short to medium term. If you or I or anyone else could do this consistently, we would have all the money and everyone else would have none. But we can't. Unless you're buying obviously risky stocks like AMC or Bed Bath & Beyond, all the work you put into determining fair value and creating a directional bias boil down to a gamble. That's probably as good as a coin flip. This gamble goes in our favor more often than not during a bull market, like the one we're in. So maybe a better metaphor would be a die, which has 4 sides that cause stonks to go up, and 2 which cause them to go down. Basically, if you're capable of maintaining a body temperature somewhere in the upper 90s, you should be making money in the current market environment. Unfortunately, as degenerate retail traders, we sometimes allow our intrusive thoughts to take over, compelling us to snatch defeat from the jaws of victory. If you're in the habit of following a few stocks you like using a watch list, you might be able to move more quickly than someone who doesn't do this. When you see a stock you're already familiar with drop to near its 52-week lows, that might be an opportunity to buy. At this point, your process may include brushing up on the technicals and checking to see if you think anything's materially changed for the company. This may include doing more fundamental analysis and brushing up on the company's revenue growth trends, cost growth trends, R&D expenditure over time, price to earnings history, all that sort of thing. You might also Google the company to see if there's any news about it. Perhaps some qualitative things that aren't so readily captured on a balance sheet.
Oh my God!
At this point, you may be ready to buy. Over time, as I've done technical and fundamental analysis, read financial statements, analyst reports, etc., I've gained enough confidence to move a bit faster on stocks than I may have in the past. Which leads me to another point. How much can we trust analyst reports? Or maybe a better question would be, what do analyst reports tell us that we couldn't figure out ourselves? I like to think of analyst reports as a starting point, an outline that triggers us to delve more deeply into certain topics. For example, Lam Research's stock recently came to my attention because it's been hovering near its 52-week lows. So I started my research by reading an analyst report which pointed out that Lam is the technological leader among its competitors, Applied Materials and KLA, in producing the equipment necessary for the etching process within the semiconductor industry. Etching equipment is very expensive, and what it does is remove material from silicon wafers. This is a process that leaves behind the circuit patterns necessary to manufacture advanced computer chips. We're talking about etching patterns onto wafers on a molecular level. The smaller and more intricate these patterns are, the better the resulting chips will be. While Lam is not the leader in all phases of chip manufacturing, its technological edge makes its products, as well as the software and engineering add-ons it provides, rather sticky for its customers. Now, I'm not a materials scientist or even somebody who works in the semiconductor industry. The reason I know any of that is because I read an analyst report. So I learned a little bit about what these processes entail. Does anyone outside the semiconductor industry know what a 3D NAND memory chip is? Probably not. Suffice it to say, if you're in the business of selling equipment that the global semiconductor supply chain depends on, equipment that creates patterns on wafers at a molecular level of detail, it's safe to say that you've got yourself a nice little moaty business. So my point is, analyst reports actually tell us quite a bit. If nothing else, they serve as a sort of syllabus that can help us learn more about the companies we want to invest in and the industries in which they operate. If you're an incorrigible nerd, the learning process can even be fun. To get your hands on one of these amazing works of nonfiction, you can either Google the stock along with the words equity research, PDF, or something like that to see if you can dig up any reports floating around the internet. You'd be surprised what you can find by doing this, and even an old report can give you some insights into the company and the industry in which it operates, as well as the performance indicators analysts think are important for that particular company. This can get you into the right frame of mind to continue on with your own due diligence. This is especially useful if you're trying to do DD on a company that's in an inherently complicated industry like semiconductors. If you're a Robinhood user, you also have access to Morningstar analyst reports for most of the popular stocks out there, and then some. For example, I pulled up the Morningstar research report for Lam Research, which provides some information about the business, its competitors, as well as some basic bull and bear cases. This is a good place to start your fundamental analysis. Once you have a grasp on the company and the industry, you can then check out things like liquidity and profitability ratios. Understanding the company beyond a completely surface level can also help increase your confidence to ultimately get you to that buy decision. This report says that Lam's fair value is $83, meaning that according to the analyst, it's a bit undervalued at the moment, so it might be a good buying opportunity. Like I mentioned before, Lam is not the leader in all areas of wafer fabrication equipment. For example, it does not lead in deposition, which is the process of adding materials onto those wafers and is another step in the manufacturing process. Lam has a healthy R&D budget of $2 billion per year, and its services are sticky due to the high-tech nature of the equipment they sell, which often needs a ton of customer-specific software as well as ongoing engineering consulting support to make sure everything is working the way it should. Most of you, I assume, watch the news, so we know that with the potential Trump tariffs combined with the political tension between the US and China, the semiconductor industry may be facing some geopolitical headwinds. However, even the mightiest roar by the most powerful man on earth could be, and often is, reduced to a whimper by the time it's filtered through Congress. So there's no need to panic just yet if you're a semiconductor investor. Anyway, I'm not going to do a full SWOT analysis for Lam here because that's not really the purpose of this video. I'm just using Lam as an example to drive home the point that you don't need to be a super genius to invest in tech companies that make equipment so technologically advanced that you'll never be able to understand them in your lifetime. If that were true, no one would ever invest in tech. Once we're satisfied with our due diligence, we can proceed to other questions. Questions like, would it be safer to buy a semiconductor industry ETF like SMH to hedge against Lam's customer concentration risk? Because Taiwan Semiconductor, the company with the best and most technologically advanced chip fabrication capabilities on Earth, is one of Lam's key customers. We talked about the stickiness of Lam's products and services, so we know that switching costs for Lam's customers are not insignificant. But I also like to be conservative, so rather than going long and buying 100 shares at the current market price of $69 per share, which according to William Kerwin of Morningstar is below their fair value of 83, I could build in even more of a cushion by selling a put option instead. That way, I can generate a bit of cash off my interest in the stock while potentially getting the shares assigned to me at a lower price point. A conservative theta gang approach to going long a stock can potentially help you sleep at night, especially when the stock market seemingly hits a new all-time high every other day. So that's my take on analyst reports. They can be a bit static, so trust your own judgment if you feel something is off or if the numbers aren't adding up. Don't depend fully on analyst reports. Do your own math and build your own fair value calculator if you want to, or just find one on the internet to use. Here's one I found on alphaspread.com, which right off the bat tells me that my conservative approach of going all theta gang on the stock at $69 a share is doomed to fail. From here you can click the discounted cash flow link and play around with some of the variables until you get the valuation that you want, to validate your own confirmation bias. But in all seriousness, you should do this, if for no other reason than to familiarize yourself with the different valuation methodologies and tools that are out there. This way you can also compare the number you arrive at with the pros, which can be fun, if not instructive. Who knows, maybe your methodology for arriving at fair value is better than what Morgan Stanley or Bill Ackman or Cathie Wood use. Remember, I'm not telling you to put all your faith in other people's work, but we need to recognize that on some level, that is kind of what we're doing. Contrary to popular belief, analysts are real people too. They have their biases and their blind spots, but I don't think our boy William is out here actively trying to fuck us over. As long as we, as retail traders, understand that neither reading analyst reports or studying outdated 10Qs will give us an edge over institutional investors. I don't know about you, but I don't have a direct line to Lam's CEO or anyone on the management team. For all I know, Taiwan Semiconductor is getting ready to drop them as a vendor right this very moment, but we don't have a direct line to TSM's executive suite either. Such eventualities are, therefore, ones that you and I can't really plan for. As gambling-addicted retail traders, we can only react to this sort of news when we wake up one fine day to see a big ugly red candlestick in our portfolio.
Fuck!
All we can do to minimize such savage blows is to try not to overpay and diversify our investments. Maybe we do this by buying a semiconductor ETF instead of Lam, or maybe we buy Lam and its main competitors, Applied Materials and KLA. That way, if TSM drops Lam as a vendor and gives all that business to Applied Materials, for example, the impact of this news would come out in the wash for our portfolio, more or less. I'm obviously simplifying a bit, but in a mechanical sense, this is how diversifying your holdings can save your portfolio from certain calamity. All this to say, whether I buy the stock at the recommended price of an outdated analyst report or through 40 hours of strenuous analysis and DD on my part, if the scenario I just described were to play out, it wouldn't make much of a difference. That's just not how this game is played. At the end of the day, I don't lose a lot of sleep over whether or not I got it exactly right. I just need to get it right enough over the long term, and that's good enough for me. That was a lot, so let's do a quick recap. I have a watch list with hundreds of stocks on it. If a stock is near its 52-week low, I investigate to see if there's a buying opportunity. I also read analyst reports, look at cash flow statements, balance sheets, income statements over the past 5 quarters. I also look to make sure that the company is not diluting its shares into oblivion by looking at trends in their basic shares outstanding, because too much share dilution could be a sign of financial distress. See Boeing. I then look at liquidity and profitability ratios, especially historical trends for the company's price to sales and price to earnings ratios. And finally, I check the stock's horoscope, by which I mean its technical indicators. After all that's done, I pray to the market gods, pour one out for the homies, and smash that buy button. So I hope this has been helpful, or at least entertaining. Remember, the point is not for you to half-ass your DD, but rather to recognize your limitations as a retail gambler in the financial markets. The painful truth is that in most cases, no single piece of publicly available information is going to be enough to give you an edge over a Morgan Stanley. Maybe it'll give you an edge over Bill Ackman or a Cathie Wood, but we should try to aim a little higher than that. If you enjoyed this video, don't forget to hit the like button. This will help me go from being a small degenerate YouTuber to a medium-sized degenerate YouTuber. I am curious to hear about what y'all are doing for your due diligence process, so don't be shy and feel free to share it in the comments. In any case, I hope you enjoyed the video, and I will see you in the next one. Bye for now.